Really have got a fantastic last panel to talk a bit about really, I suppose, what success is going to look like in the future. And if you were, for instance, an investor and you're looking to put your money on the best, most liquid platforms, the ones who are really achieving all their goals, what are you going to be looking out for? And so we've got two, actually, I think probably two of the most interesting crowdfunding equity platforms globally here. You've already heard a little bit from Gonzalo from the UK. Syndicate Room's been doing some amazing numbers. And I'm very, very pleased to have Gadi along. Our crowd in Israel is doing amazing business in terms of crowdfunding equity. And I have to say, some of the most interesting companies that are getting funded globally from the crowdfunding equity, apart from obviously on Cedars, our colleagues earlier on Syndicate Room, are getting funded on our crowd. And I think our crowd have probably you've had the first business that's been listed on the US markets. Yep.
We had the first exit in September, a company called Rewalk that went public in NASDAQ. We invested 3 times.
3 times?
Yeah.
And I think what's true to say is that what our crowd are doing, from an institutional perspective, even though you're not really institutional investors, it's more sophisticated high net worths, is you've got institutional level kind of investing that's going on in what you're up to. So, and quite big ticket sizes as well, aren't you? I mean, you were telling me you've got quite big, weighty numbers going down on business that what we would expect traditionally is as big VCs in the UK.
Yes, we actually, Paul's company, Bo, was funded by us just recently. 2 weeks ago, we closed the largest equity crowdfunding round. We led, and that's the critical thing, we led a $19 million round with $6 million coming from us, and VC joining us in the round. An equity crowd platform actually led. So that's also a first.
And that's the same, because your platform, so you've had VCs quite often working with what you're doing as well, haven't you?
Yeah, we've had the whole range, to be honest. We've had VCs investing alongside the lead investors and through our platform, and VCs leading investment rounds. Okay, so, and I think it's probably fair to say that crowdfunding equity, if we look at the numbers, Rupert, it's still quite small compared to peer-to-peer loans. Because actually, you look at the numbers, and I'm guessing, what, a couple of billion for loans, crowdfunding equity?
Yeah. So UK peer-to-peer is through 3 billion, we think 5 billion by the year end. The crowdfunding number, I would love to be able to pull off the top of my head. It's not even close to $1 billion in the UK, that's for sure.
No,
so
it's
significantly smaller.
So what is it, how have you managed, Gadi, to get people to put the amount of money that you have onto individual investments? Because I think it's fair to say that, actually, it's not, I mean, actually, both Cedars and Syndicate Room and Crowdcube are now getting quite big numbers in terms of 1 million, 2 million that is going on platform. But you've been doing it for quite a while, and you get to how have you managed to get the money out of investors? Because they're not giving it to you because they think it's like early stage startups and they might lose their money. They're investing it because they think they're going to make a real return on their money, aren't they?
Yes, and I think the critical thing is, we did rounds, when we started, we did rounds also about $1 million. That was our sweet spot. That was about 2 years ago.
When you started $1 million?
We started at $1 million, yeah, at $500,000 to $1 million. That was what we looked at as a sweet spot. The largest we did so far is 7.5. So
7.5.
That's grew quite a bit over the last 2 years. I think the key thing is basically that unlike just equity platforms, the investors actually trust the leading of the one who lead the round. In our case, that's us acting as a VC. In the case of syndication platforms, that's basically the lead angel. So you see,
someone's doing the due diligence for you.
Someone is doing the due diligence. Someone has, even in the case of top angels leading the round, the investors that join the round in many cases are people that trust that specific angel. Not just the due diligence thing, but basically that if he put the money and if he got them into the deal, there's also a professional and kind of relationship thing of them joining with him. And the same happened now with us as. In many cases, they trust us and they join. We put our own money in each one of the deals that we fund. So we have
so your own skin in the game.
We have a skin in the game in each one, and basically the whole messaging to the investors is: we screened that company, we decided to bet our own money on this company, and you are invited to join us. And that's a major difference than just being a platform that potentially matches investors in startups.
Gonzalo, I mean, again, how have you, because I mean, just run us through your numbers in the last sort of 6 to 12 months. You've shot ahead.
Yeah, we did. So well, I can't really to say in the last 18 months, because we haven't even been live for 18 months. So we have just, last night, for example, just closed a £1.56 million round, which took us to about 18.5 million raised for the companies through our platform in 15, 16 months. And we were one of the last entrants to the market.
I'm about to say, yeah,
but I think it's just about the model, right? It's exactly the same principle as our crowd. Is having someone that actually carries out the due diligence, someone that is putting their own money in first, and then allow everybody else to piggyback on that.
At this point, I want to bring in Mike, who's been very patient. Mike does, amongst other things, does a great podcast around fintech, sorry, Fincast. That'd be good, wouldn't it? But you talk to all the people, both in the peer-to-peer and the crowdfunding side, about risk a lot, actually. So what's your take on, just from standing back, not just in crowdfunding equity, but peer-to-peer loans as well, how do you manage that due diligence process when you're looking at both the platforms and the individual investments that they're doing on it? What should you be looking out for? Because you really do talk to everybody in the industry, a bit like we do at AltFi.
No, indeed. A number of people in the audience have been on the podcast and are coming on it soon.
Yeah.
I think going back to the hyper big picture, in every tech industry, you've got a startup, a scale-up, and then you've got a mature company. The startup, you've got string and sellotape. It's a craft-based thing. You run into tech debt. And then by the time you're in the scale-up, you start paying that off. And how I see kind of everybody in the room at the moment is it's like the peloton in the Tour de France. Some of the people at the back of the peloton are still in the startup. Some of them are quite a long way up the scale-up. Going back to the risk thing, where I'm writing some articles for you guys on AltFi News on risk, it reminded me of the fact that in January I've been in the city for 30 years. So looking at it from the opposite perspective, which is how does everybody in this room compared to a mature FS thing, what needs to be closed up? Well, I think that metaphorically speaking, it needs to be turned into more of a BMW Audi factory.
Yeah.
Where everything is robust, precise, engineered to the same kind of business standards you have in a city group or that kind of thing. And everybody's on that journey, and nobody's kind of got all the way there yet.
And probably pay the same price you pay for a BMW. And it should say that before Mike talked about fintech, you worked in the financial services industry as a risk expert.
I'm still in it. As far as I'm concerned, I'm still in FS. I've been there for 30 years.
Yeah, exactly. Just a different bit of it.
The reason I'm in this bit is this is the most interesting stage at the moment.
So, Mike, looking at it from your perspective, where's the blow-up going to happen?
Very interesting question. I think what other people have said to me about that is that, and it's certainly the interesting stuff is what they say in the evening after a few beers, as opposed to on the podcast when I turn the microphones off, as you know, being a journalist. I think the biggest worry that most people have in common off the record is that someone else will, pardon my French, fuck it up. A platform will do something very naughty, and then the sort of scheisse will hit the fan and go over everybody. So I think it's the main worry. And then you've got the usual things about fraud and cyber and all that kind of stuff, as opposed to, we thought it was a 5% yield, it was only 4.9 because of credit losses.
Gary, I mean, again...
Absolutely. I mean, that's the largest fear, and I can say that even without the beer. I think that we as an industry have this, I wouldn't call it hype, but I mean, to the investors, the power of hype with the investor. And,
momentum.
It was mentioned. It was the nickname MOFO. FOMO, the fear of missing out.
Yes.
And this can potentially get investors that do not know what they're doing to join rounds, and that's what we fear. And we look at ourselves as basically a democratized VC. We don't look at ourselves as a equity crowdfunding that is just a platform. We actually make our own decisions, but still being part of the equity crowdfunding scene, our biggest fear is one of the other guys, of course not us, fucking up.
Rupert, I'm going to bring you at this point, because one of the ways of maybe not screwing up is, exactly, I'll let you guys say it, is actually transparency, isn't it? Because that's actually one of the best ways of doing it. And how transparent is the industry at the moment? When you go and talk to platforms, are they actually all opening up to you?
So I'm going to answer that question slightly differently. It's been very interesting sitting here actually reflecting on particularly the two crowdfunding models we've got here, if I can call them that. And what strikes me is that what's central to the model is price discovery and confidence in price discovery. Because ultimately, that's what transparency is. We all talk about transparency, and we actually never really stop to think, well, what is transparency? Transparency is price discovery. And people will think a market's transparent if they're sure that somebody's actually done the work to enable them to make an informed decision. And that's really what price discovery is. And clearly, when you're using a model where you've got VCs, you've got experts leading a round, and then you've got a crowd joining that round, you are introducing confidence in the price discovery process because somebody's had the opportunity to do the DD. Okay, so I guess I kind of thought of this on the hop slightly, but what I'm trying to say is that transparency comes in many forms, and really the way to think about it for me is has the price discovery process happened efficiently? Have the people who are putting their capital at risk been able to make an informed decision? And that's what's so important to this industry, because whether it's crowdfunding, equity, or debt, ultimately this industry is trying to create a track record for both borrower and lender. And it's not about a trader trying to get the right price, trying to get the most aggressive price. We want business to transact at an enlightened price, at a price that, on reflection, in hindsight, will look realistic. Because that's how you gain credibility, and that's how you gain the confidence of both sides of the equation. But of both the investor and the person who needs the capital.
And I suppose my question, maybe in the crowdfunding space as opposed to peer-to-peer space, and I'd love to hear your opinion on this, is have we seen, you guys at AltFi Data are trying to do the benchmarks. The numbers are there. They are now transparent. Crowdfunding equity, with the best will in the world, that's why I was so keen to get you here, Gadi, particularly because you've got some exits now, but you've got some quite interesting deals that have gone to second, third stage, and you've had an IPO as well. Yep. Transparency is not there in the crowdfunding equity sector, is it?
All right. I would say on our platform, yes, I'm pretty confident that it is, and it has the lead investor. On other platforms, not really my place to comment on it. But I think it's really important in a price point perspective on transparency. It's amazing. Let's not forget that this is an old asset class. It's just being open to new people, to people that are new to this asset class. So there's a lot of learning and a long learning process. And throughout that process, there will be transparency coming in. Yep. But it will also be, ought to be a lot of education through the process. And by the virtue of that education, that's when people will start pushing for transparency. And don't forget that for these asset class, be it equity funding or peer-to-peer loans, but probably greater impact on the equity finance, is that for it to be sustainable, has to work for investors. If it doesn't work for investors, all of us will be looking for a job in 5 years' time.
Completely. Gary, I'll be interested in your perspective on this.
Yeah, I think that our platforms, we definitely see ourselves as very, very transparent.
Yeah.
So when someone invests in us, he sees the full details, of course, of the deal. All the deals are in roughly the same legal framework, so he knows that he has the rights protection, participation rights. I mean, everything that the VC would have in a deal. I think that the holy grail in terms of size, and we're starting to see that, is actually attracting investors that are looking at that never invested in private equity before. And we did statistics a few months back. 80% of the money that came that month came from investors that was the first time that they invested in private companies before. So they do not look at themselves as angels. So if you basically say the wealthy individuals should be able to invest in this asset class and participate, and that's what we call democratizing VC, but participating in the deals that were close to a very small circle of GPs or VC with $10,000 at the exact same term that the VC would have invested, and actually create a portfolio. If he invests $100,000, he can actually create a portfolio of 10 companies. That's the holy grail. Not really facilitating transactions between people that look at themselves as angels and startups, but opening that to a much, much wider crowd.
And Mike, I want to finish with you. I sometimes talk a lot, like you do, to people in the industry, and the end of this...
Sometimes talk a lot, full stop.
Yeah. And you've done too as well, Mike, actually. I haven't this online. Is that you talk a lot to people in the industry, and the end of this road is things like securitization for loans, for instance. The end of the road is IPOs for crowdfunding equities. That's true, isn't it? Whenever you got an IPO, it's like, that's it, great.
We've got a trade sale. But.
Absolutely, a trade sale. Yeah, absolutely, yeah. An exit, yeah. Securitization, but it's quite often public markets, isn't it? And, I think Christian Faze has just announced he's doing a lend invest, he's going to try and do an IPO later in the year. Sure, Stuart's been thinking about that and assets. But the end of the road is public markets, securitization, IPOs, listed businesses. Do they really want to go there?
I think going back to 30 years in FS, I can think back to some examples in the 80s around securitization. When people mention securitization in FS context, I start to sweat.
Yeah.
And I've seen, as you have, many, very few of them have stood the weight. And there's a very simple fundamental point, and this applies to alternative finance as well. The problem with securitization is that somebody takes a bunch of stuff, puts some of the stuff in his own pocket, and then takes what's left and gives it to the marketplace. So invariably, you've taken value out. Now, the ones that have done worse have been those, particularly on Wall Street and that kind of stuff, where Goldman's and co. have taken a hell of a lot of value out, so what's left is poor value. So securitization, where not much is taken out in passing, isn't too painful. But I think the key to securitization is how much did the originators make out of it?
Guys? Rupert?
Yeah, maybe my youth leaves me more optimistic and positive about the merits of securitization. I guess I totally acknowledge that point. Clearly, it has to be done well, but it strikes me that securitization in this industry is something that would make me really excited because, you can repackage stuff to change the return profile. So you can massively increase the audience, the investor audience, because you can give the first loss piece to someone who's got risk appetite and recognizes the dangers in the first loss piece. You can therefore give a much more safe piece to someone who needs protecting, like a ISA investor or Mrs. Miggins. So I guess, it's beholden on this industry to make sure that there's not someone in the middle who's nicking some of the best bits and using opacity to not allow securitization just to be a function where the right risk sits with the person who's got the appropriate risk appetite.
Just one last question, and then I'll get it in.
That comes back to what you were saying about transparency. So if there's a securitization process, someone has taken 0.1% of the value out, I'm not going to sweat. If the securitization process, and as in the past, an investment banker like yourself will know, Rupert, 10, 20, 30% has disappeared before it's restructured for the people to buy.
And one very last question, very quickly. You guys, how many IPOs or public listings of underlying vehicles that you've invested in do you expect to see over the next 2 to 3 years?
We never say that.
That means loads. Gonzalo?
Dito.
Are there any questions before we finish off the evening? If you do want to put your hands up now. We will try and find you. Obvious, because I can see the power of alcohol is beginning to drag people downstairs already. Well, look, I'm going to thank these guys for coming along and put your hands together, and thank you very much for coming along.